The decision to accept or continue an audit engagement represents one of the most significant professional judgments made by an audit firm, as it directly influences audit quality, independence, professional reputation, and legal exposure. Before accepting an appointment, auditors must comply with the ethical requirements established by the Code of Ethics and the International Standards on Auditing, particularly ISA 210, agreeing the terms of audit engagements and quality management requirements under ISA 220, revised. Acceptance procedures are designed to ensure that the auditor possesses the necessary competence, independence, resources, and ethical standing to undertake the engagement while minimizing engagement risk. Failure to conduct appropriate client acceptance procedures may expose the auditor to litigation, regulatory sanctions, reputational damage, and association with fraudulent financial reporting. Audit firms should therefore establish robust acceptance and continuance policies as part of their overall quality management system. Professional ethics play a central role in determining whether an audit engagement should be accepted or continued. Prior to acceptance, the auditor must evaluate compliance with the fundamental principles of integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Particular attention should be given to threats affecting auditor independence, including self-interest, familiarity, advocacy, intimidation, and self-review threats. The firm should also assess potential conflicts of interest, fee dependency, relationships with management, and the availability of appropriate safeguards capable of reducing ethical threats to an acceptable level. Where independence cannot be maintained or significant ethical threats remain unresolved, the engagement should be declined or discontinued to protect the public interest and preserve confidence in the audit profession. ISA 210 establishes specific preconditions that must exist before an audit engagement can be accepted. Management must acknowledge and understand its responsibility for preparing financial statements in accordance with the applicable financial reporting framework, maintaining adequate internal controls necessary for reliable financial reporting, and providing the auditor with unrestricted access to all relevant information, documentation, and explanations required during the audit. Furthermore, the auditor must determine that the applicable financial reporting framework is acceptable for the preparation of the financial statements. If management refuses to accept these responsibilities or imposes scope limitations likely to result in a disclaimer of opinion, the auditor should not accept the engagement unless required by law or regulation. These preconditions establish the foundation upon which an effective independent audit can be conducted. The process of obtaining an audit engagement normally begins with an invitation from a prospective client or statutory appointment by shareholders. Before accepting the appointment, the audit firm performs comprehensive client evaluation procedures, including consideration of management integrity, business reputation, financial stability, industry risks, regulatory environment, and previous audit history. Where replacing an existing auditor, the prospective auditor should obtain professional clearance by communicating with the outgoing auditor to identify any professional reasons why appointment should not be accepted. Client permission should first be obtained before such communication occurs. The auditor should also evaluate whether sufficient resources, industry expertise, specialist knowledge, and time are available to perform the engagement competently while complying with professional standards and quality management requirements. Only after these procedures have been satisfactorily completed should formal acceptance occur. Acceptance procedures do not conclude once the initial engagement has been completed. Audit firms are required to assess continuance annually by reconsidering whether circumstances have changed sufficiently to affect the appropriateness of maintaining the client relationship. Factors requiring reconsideration include disputes with management, evidence of unethical behavior, significant litigation, financial instability, restrictions on audit scope, recurring disagreements regarding accounting policies, suspected fraud, or deterioration in management integrity. Where such issues cannot be satisfactorily resolved, resignation from the engagement may become necessary to protect auditor independence and professional reputation. Effective continuance assessments therefore contribute significantly to maintaining audit quality and reducing engagement risk over successive audit periods. Following acceptance, the auditor and client must formally agree the terms of the engagement through an engagement letter before audit work commences. The engagement letter establishes the contractual relationship between the auditor and the client, minimizing misunderstandings regarding responsibilities and expectations while documenting the agreed scope of services. It serves as legal and professional evidence of the engagement terms and provides a reference point throughout the audit. Although engagement letters need not be reissued annually where terms remain unchanged, they should be reviewed regularly and updated whenever significant changes occur, such as amendments to legislation, auditing standards, ownership structures, senior management, or audit scope. The engagement letter should contain several essential components prescribed by ISA 210. These include the objective and scope of the audit, the responsibilities of the auditor, the responsibilities of management, identification of the applicable financial reporting framework, and reference to the expected form and content of the auditor's report. Additional provisions commonly include reference to professional standards and applicable legislation, inherent limitations of the audit, management's responsibility to provide written representations, arrangements concerning audit fees, communication protocols, access to information, and management's obligation to notify the auditor of subsequent events. The letter may also address the involvement of internal auditors, limitations of auditor liability, and arrangements concerning access to working papers where appropriate. The engagement letter should be agreed and signed by management before any audit procedures commence, thereby establishing a clear understanding of mutual obligations and supporting the effective planning and execution of the audit engagement.